In this video, we'll help you understand SEP IRAs and simple IRAs so you can decide if either one is right for your business. If you don't know who I am, my name's Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. It's not uncommon for a number of our clients to have access to some form of self-employment income. And whether it's the spouse who contributes his or her self-employment income to the overall family, or if the self-employment income is the primary method of income for the family, oftentimes self-employment can come with a myriad of tax opportunities, not least of which is the ability to take sizable retirement contributions out of the business and help save on taxes. In today's video, we'll break down the two most common starter self-employment retirement plans that I see, SEP IRAs and simple IRAs. So let's jump in. Previously, before the passing of the Consolidated Appropriations Act of 2023, or the Secure Act 2.0 as it's called colloquially, back at the end of 2022, before 2023, there was only the option for SEP IRA and simple IRA participants to make pre-tax contributions to these plans. After the passing of Secure Act 2.0, employers and employees are now able to create and fund Roth SEP IRAs and Roth simple IRAs. This also means that if you have a pre-tax SEP or simple IRA set up originally, and you wish or you'd like to have that money now in a Roth SEP or simple, you could do Roth conversions if you forecast from a tax planning standpoint that that's in your best interest. This ability was not available before 2023, unless you did some roundabout fashion of moving money from a SEP IRA to a traditional IRA and then doing a conversion. But this essentially eliminates hurdles of doing that, and you should be able to do all sorts of in-plan Roth conversions natively now that you're allowed to have pre-tax and Roth money inside these plans. Now, technically, SEP IRAs and simple IRAs are different than other retirement plans you might be familiar with, like 401ks. And since they're IRAs, they come with a lot of the baggage that regular IRAs come with. Obviously, required minimum distributions is part of that, but unfortunately, the ability to take retirement plan loans from these retirement accounts is not permitted because they are IRAs. And while these plans do fall under a portion of ERISA purview, they are not held to the same administrative hurdle requirement as some of these massive plans like 401ks, 403bs, etc. Essentially, that just makes your life as the business owner a lot easier because the requirements to maintain these plans is a lot less. That said, there still is some specific IRS guidance on how to run and administer these plans, so let's jump into how those work. Let's start first with SEP IRAs. SEP IRA stands for Simplified Employee Pension. I personally find that this plan is the easiest to understand and run, so I figured that'd be a great place to start, and I think it works best for folks that don't have any employees. The maximum anyone is allowed to fund into a SEP IRA per year is the lesser of 25% of their self-employment compensation, or $66,000 a year for 2023, which is also the defined contribution limit for 2023, which also means that that limit increases every year. But the 25% number doesn't change every year. Now, the IRS does have a specific definition for the word compensation as it pertains to getting that 25% number. It's essentially however much net self-employment income comes to you from the business minus half of your self-employment taxes, as well as however much you are putting into the SEP IRA. For more information on that, see publication 560, which I'll link below. As a quick example to understand these contribution limits, let's say you run a single member LLC, everything gets passed through and you ultimately file a Schedule C for this. If the business revenue or net income to you forms compensation of $100,000, that means that your maximum contribution is 25 grand, not 66,000. On the other hand, let's say your business was still a single member LLC that passed through income, and your compensation for the year is $300,000. Well, 25% of that would be $75,000, and that's higher than the 2023 defined contribution limit of $66,000. So in this case, the lesser of the two would be $66,000, and that would be your maximum contribution if your business was making that much money. And although you can't make catch-up contributions to SEP IRAs, my hunch is if your business is making over $300,000 a year and you want to save more for retirement than just $66,000, you might want to look into setting up different retirement plans, which we'll talk about in further videos, that have more liberal contribution maximums than just $66,000. The nice thing about SEP IRAs is they offer flexible contributions, so you're not locked into making a similar contribution every year, nor are you locked into matching any of your employee contributions if you do have employees. There's also no annual testing or annual reporting that you have to send to the IRS, such as if you had like a 401k or 403b that you were administering. those do have annual filing requirements, and you don't have those with a SEP IRA, so it keeps it simple. That being said, it probably would still make sense to do an annual audit of your plan via an IRS checklist, which I'll link below, just to make sure you're not running afoul of any new guidance that might have cropped up while you were running your business and you didn't follow irs.gov publications. If for whatever reason you choose to terminate a SEP IRA in the future, the good news is there's no filing requirement with the IRS, there's no notice you have to give them, it's just cut and dry. Just talk to whatever financial institution is running the plan and have them close it out. Now, if you do have employees, I would recommend speaking with a financial expert on this because the rules can get a little bit nuanced, but long story short, the number one rule to take away is whatever percentage contribution you want to make into your own SEP IRA, if you have employees, you will need to set up a SEP IRA for each one of them and make the same percentage of compensation contribution to their SEP IRA. Also, there's no elective employee contributions to a SEP IRA. The only entity that can fund the SEP IRA is the business itself. The IRS calls this making uniform percentage contributions, where everybody gets the same percentage of compensation. Now, just because they are an employee doesn't necessarily mean that they are entitled to be a part of the SEP IRA pool based on age and work history and compensation. You may be able to exclude them from the SEP IRA participation. One unique benefit of SEP IRAs is the ability to maximally fund different retirement plans without the SEP IRA disenfranchising you. To explain that a little clearer, let's say you as your self-employed individual set up a SEP IRA, it's making $300,000 a year, and that permits you to fund $66,000 in maximum contributions. Also, if you have access to a 401k through, let's say, some W-2 work that you do, and you want to maximally fund that at the $22,500 limit, or whatever the defined contribution limit is for you at this time, you're also allowed to make that maximum contribution as well, plus whatever matching happens within that 401k. Simply put, your SEP IRA contributions do not disenfranchise how much you can maximize in your other company's 401k. However, if the SEP IRA and the 401k are both at the same company, which if you are doing that, I'd be curious to know kind of what the justification is, but let's just say you are doing that, then your SEP IRA contributions will disenfranchise how much you're allowed to fully fund into your 401k. A couple pieces to note about deadlines. The deadline to open up a SEP IRA for the tax year in question is the due date of your business's tax return, which if you're self-employed with no employees, odds are that's all going to flow through to you and that's going to populate on the Schedule C, which means that your deadline to open up a SEP IRA is April 15th or October 15th if you took an extension. Likewise, the deadline to fund the SEP IRA, which is unique for IRAs, is April 15th or October 15th if you took an extension. This is unique because traditional IRAs and Roth IRAs both have April 15th deadlines to fund, whether or not you took an extension. And then last thing on the SEP IRA front, if you hear the term SARSEP, this is referring to a type of SEP plan that's very much outdated and it's sort of an old model. Long story short, as of 1996 and beyond, no new SARSEPs were allowed to be created. So if you hear the term, there's a little more nuance going on there than just this SEP IRA stuff we talked about. Okay, so that covers SEP IRAs. Let's jump into simple IRAs. I ultimately find simple IRAs to be less common and for the most part, to be a very, very small version of a 401k plan. So generally, these only make sense if you have employees and you're moving in the direction of setting up a 401k, but maybe you're just not quite there yet. Simple IRAs stand for Savings Incentive Match Plan for Employees. Simple IRAs provide for flexible employee contributions up to their own IRS limits, which for 2023 is $15,500. And as opposed to SEP IRAs, simple IRAs do permit catch-up contributions, again, up to their own limits, which for 2023 is $3,500. That also means that you could potentially put more into a simple IRA than you could in a SEP if, let's say you want to put in more than 25% of your total compensation from your business into a retirement plan. Simple could be the way to go if $15,500 is more than 25% of your compensation. On the other hand, if your business is cranking off a ton of income, then odds are a SEP IRA would allow you to tax deduct or at least defer more than a simple IRA. In a similar vein to SEP IRAs, there is no annual filing requirements with the IRS, but again, you'll still want to probably perform an annual audit just to make sure you're not running afoul of any IRS guidance. If you choose to terminate your simple IRA plan, in the same way that a SEP IRA does not require IRS notification, neither does a simple IRA. However, a simple IRA will require you to notify your employees, and you do have to maintain the simple IRA until the end of that calendar year. because you promised things like matching, which we'll talk about in a second, and those promises do need to be fulfilled. Unlike SEP IRAs, you can't have a simple IRA and another retirement plan that you're actively funding. Another retirement plan like a 401k, for example. And if you do have employees, you will need to set up a simple IRA for each one of those employees, and then you will have matching requirements. Those matching requirements, you get two options. One, you can either match dollar for dollar up to 3%. So theoretically, if somebody makes no contributions, you won't have any matching. But if they at least contribute 3% of their salary, you'll owe them a 3% match. Your other option is to just do an automatic 2%. It's called a safe harbor contribution, where you're automatically giving every eligible employee 2% into the plan, regardless of how much they contribute. The IRS gives you either option to fulfill their requirements for administering a simple plan. Now, luckily, that 2% is limited to a particular compensation level. For 2023, that's $330,000, which means the amount that you'd be automatically putting into their plan would be limited to about $6,600, or 2% of their salary. And similar to SEP IRAs, you are allowed to exclude certain employees from the simple plan if they don't meet particular eligibility criteria. One very unique thing with simple IRAs is the 2-year clause, and that essentially just means for the first 2 years of the simple IRA being in existence, you are not allowed to do any sort of rollovers out of the simple plan or rollovers into the simple plan. And if you withdraw money from the simple plan within the first 2 years, not only would you owe a 10% penalty tax if you're under the age of 59 and a half, but that penalty tax will actually be increased to 25%. The deadlines for simple IRAs are a little bit different. The deadline to open up a simple IRA is October 1st of the year in question. The deadline for employees to make contributions is the calendar year in question, but the deadline for the employer to make matching contributions, that isn't until the tax filing deadline, April 15th, October 15th. So calls to action wise, I would say if you are planning to open up either one of these plans, if you don't have an intimate knowledge of the financial space, it'd probably make more sense to speak with a financial professional. But definitely when it comes to simple IRAs, if you do have employees, you're going to want to make sure you're doing things by the book because these are a little bit more complicated than SEP IRAs, in my opinion. Hopefully it was helpful in sharing the differences between the two. If you have questions, let me know, drop me in the chat below, send me an email, we'll get you squared away. Have an awesome rest of your week. We'll chat with you later. Bye.